Hello, everyone. Thank you for joining us today for today's EEA Education Series Interest Group. Today, we will discuss the ETH proof of stake in validator economics and why yield farming is a thing. Everyone is in listen-only mode. However, you're encouraged to ask questions by using the questions box on your control panel. Today's call is being recorded and will be available to all attendees soon after today's presentation. The Enterprise Ethereum Alliance is a member-driven standards organization whose charter is to develop open blockchain specifications that drive harmonization and interoperability for businesses and consumers worldwide. We welcome any and everyone to join and become part of our global community. Today, our presenter is Konstantin Richter. He's the CEO and founder of Blockdemon, and Blockdemon is the leading blockchain infrastructure platform for major blockchain protocols, including a number of proof of stake networks. At this time, we are pleased to introduce Konstantin Richter.
Hey, everybody. I hope you can hear me. Sorry, I was on mute. Very nice to meet everyone. I'm Konstantin, CEO and founder of Blockdemon. I'll walk you through, who we are and what we do in a little bit. Let me just actually make sure I know how to do this right. Okay. Sorry, guys. All right. So, I'm currently based in Berkeley, California, sitting in an Airbnb, hiding away from my kids. And I've started Blockdemon around 2.5 years ago to become really the Datadog / Stripe for blockchain infrastructure. So, but today we're going to focus on proof of stake and scalability and validator economics and yield farming. So, quite a few subjects. The way I've laid out this respective talk is to go in and introduce ourselves and then walk you through different increments of tech as well as financials, and then bringing it back to our respective product suite. As mentioned, there's a QA button somewhere in there, so I'll try and look at it. Feel free to interrupt me, as long as you're not too crazy with questions and stuff. Always good to get some input and feedback also. If things become too technical or abstract, then feel free to let me know. All right, so introduction, we're going to talk about this. We talked about this. So so this is us, just sort of a snippet. These slides this is actually old. I just are not old, but we actually have over $1 billion on tokens run on nodes we operate. We support over 30 protocols, public permissioned. And really what that means is on blockdemon.com, we have a marketplace. And in that marketplace, you can click on all your preferred blockchain protocols and find multiple different ways to connect to them ultimately, which is either via full nodes as well as APIs and shared nodes. And so we try to cover all the infrastructure needs an institution has. So we support any cloud. We have on-prem packages and scripts that people can use in order to manage their own nodes. And then we provide a bunch of different performance tooling, et cetera, et cetera. Ultimately, what you pay us for is that your node will be up and running all the time. And if it isn't, and there are any financial consequences to it, that we're liable and not you. And so it's not overly difficult to deploy a node. What's difficult is to make sure that the node performs to a very high degree of quality. I.e., our customers are large exchanges, funds, enterprises, and so they can't really have a period of time where suddenly they can't, for example, process these Ethereum transactions for a day. That would not be a scenario that works. We're venture backed and been active for a bit, so it's excited to share a little more about it. The way our solution works is, we support a lot of protocols across a lot of pre-configured infrastructure, and then have all the different sort of add-ons, support functions, et cetera, that any institutional grade customer might want. And so again, the idea here is to abstract the complexity away while ensuring very high degree of performance of nodes, as well as security and decentralization via working with any different cloud provider that you like. So managing access and even our own ability to actually toy with nodes that we operate for our customers is very limited, which is an important factor when we talk about our product. And so the starting point here, since we're going to talk about validators and yield farming and all that other stuff, is let's introduce you to the concept of what nodes are. And people mention the word node very easily. Ultimately, what nodes are have three very distinct components. There's a storage component in which a copy of the ledger lives that becomes larger and larger over time. There's a compute component and a software layer that contains the consensus mechanism, which ultimately tells the storage part of the node what to add and when, and how to shut things down when certain circumstances occur. Those are specific to protocols. Each protocol, when you hear all these different protocol names, ultimately what that means is they have slightly different rules on how they validate a transaction, how many peers need to be connected to that node in order to function, and then different types of ways how data is added into the ledger, for example, smart contract capabilities and stuff. But so you have storage. Top of that, you got the compute component that storage looks similar, on all blockchains. But there's the storage component, and the size of it can vary across the different types of nodes within a protocol, and that's what you see here. For example, you have watcher nodes, validator nodes, relay node, participation nodes, archive nodes, and so really what that means is they have different types of software and very often contain a different depth of ledger. So when you deploy a node, for example, fresh in a network, you normally start at the point of time at the block height that you join to validate. So the ledger that you have ultimately creates history from that moment forward. Very often our customers are companies who need also access to all the historical data, which is then an archive node. And certain archive nodes for certain protocols, we're talking about terabytes and terabytes of data. And so that tends to be a big cost factor when it comes to nodes. The third component, so we've got storage, we've got the software part, and then we got the connectors, the peers, the way the node physically actually communicates. And so those are and within the three, the deviations within the three make an individual protocol, right? And so and so each protocol has similar core components, but they're also very different within those individual components, right? And so that's I'm just going to check what's in my little QA box over here. Let me see. Oops. Let me see. I'm trying to see. I see a question in the Q&A field, but I can't actually access it. Let me see if this works. Whoop. No. Sorry, guys. Let me see. What am I doing here? Okay. Oh. Sorry, guys. Oh, here we go. No. I clicked a button and I'm
the request is to speak more loudly.
Okay. Yeah, and sorry, I'm trying to figure out, 1 second. I need to figure out how this works. Okay. Whoop. Okay, let me go back. Where am I? 1 second, guys. Sorry about this. Let's see. Where were we? Okay, sorry about that. Right here. Okay, let's keep going. Okay, let me make sure that you guys can hear me. Okay, so we have different node types, and the biggest complexity is actually when you want to authenticate what's in a node from scratch. So when you have a historical node, for example, one of the big challenges is always, do you just copy the existing ledger from another node that contains, for example, a full ledger? At that moment, you're introducing a component of risk because you don't know if that individual node has jeopardized or played with a ledger. And so the best way to do it is to sync the node back in time. which for larger networks can take over a month, 2 months, 3 months of time, because there's been so many transactions that you need to verify. But those are actually the reasons why institutions work with companies like us, because there's a lot of complexity on how to run these things and to retain authenticity of the information, because the only reason why we do this is that the data within them needs to be absolutely trustworthy. These decentralized blockchain networks are low performance and introduce a lot of complexity. The biggest complexity is on the software layer, because these networks function in a nonlinear manner, which means Ethereum is a great example. Even though we pretend Vitalik is Mr. Ethereum, there isn't really a Mr. Ethereum. The community decides when updates happen and software forks occur. It's not a linear process that an enterprise can rely on. Like, oh, every Monday at X amount of time, something gets released and we just look at it and it's been audited and pre-vetted and all that type of stuff. That's not how open source decentralized networks operate. There's a component of unpredictability and chaos that a lot of institutions can't fathom for insurance and legal reasons alone. And so being the buffer in between those two worlds is really important from our perspective, and one of the key components we provide. So for example, on the software layer, a software update might drop that if you're not updating the software, your node can't connect to other peers in a relevant manner. And so, for example, one of the big questions we always get asked, how we handle these updates and how close in time are we to update nodes forward. Again, that's really the service you pay for. You don't want to worry about this stuff because these updates might drop very rapidly. It'd be like, hey, there's an update, do it now, or you're losing connection. And it's like, oh, wait, where's our engineer who set up the node in the first place? Get him in here. And so these things are fairly complex to operate. A couple of things here, what it takes to operate nodes for blockchain networks. And so from our perspective, we're the most used system. We were the first hybrid cloud deployment tool. So I always say we're the most battle tested system, which means because everything is nonlinear and crazy, experience matters. Building tools that can handle the unpredictable is very difficult in software and can only be done via iteration. And so it's very difficult to become a quality node operator without experience. Not impossible at all, but I'm just, like the experience you need in order to juggle all these different protocols, updates, requirements, peer connections, storage sizes, etc., is a huge factor in overall the quality of service that you can provide. And we're very early still in this stage, but we've had over 1,000 full nodes that we run for institutions across multiple different protocols, and these nodes had things occur, and we develop procedures and technology in order to deal with it. And so there's that's a very important function for us. I think the other big thing for our validator and enterprise staking solutions, so we offer white label nodes for enterprises on POS networks, for example. So there's validators in certain networks. Validators are nodes that validate a transaction. And so most networks, for validation, it means that all these nodes need to interconnect to each other and agree on what those transactions are. The more validators you have, the slower the network. And we'll talk about that. Most networks on the POS side are sort of capped at around 100 validators. Doesn't mean that that's the full amount of nodes. It just, those are the nodes that can validate the transactions. There still might be archive nodes, nodes that read and write to the blockchain, but they don't validate transactions. And so, and that's something to keep in mind here. We never control a client's fund. We can have a node up that says whatever bank of whatnot, or fund an investor, and you wouldn't know it's us, but we run the full node, and they just delegate their tokens to them, but we never hold custody of funds. It's an important distinction as an infrastructure provider. And so we are, we're running the node and validator. We're responsible for the performance of the validator. So we take on the slashing risk, for example, which is an important component for a lot of our investors, specifically larger institutions who in their investment memorandi could not, for example, stake tokens that are at a risk of losing principal value. And so what that means is, makes a ton of sense, is that you have, if somebody says I buy $10 million worth of Ethereum, I set up a fund for it. There are certain risks that are acceptable to the fund, and very often slashing probably wouldn't be one because it's unpredictable. And as an LP, an investor in a fund, if I give you 10 million bucks, I want you to minimize the risk where suddenly I lose 5% of the holdings because you ran a shoddy node, for example. And so us providing insurance allows more investors to actively stake and participate because for legal reasons, they would otherwise never take the risk. And so investors like downside protection more than upside. And so that's been interesting and something for us. And so it's been a worthwhile experience for us to run staking nodes for institutions. And there's been a ton of demand to do so. And so that's where we sell a ton of tech in that respective world. And so ETH 2.0. And so let's talk a little bit about timelines and things like that. So it's been a very long process. If you know anything about it, which by the name of this you do, then you know that Ethereum to that point is very unpredictable. And to that end, for example, launches have been delayed, just mostly because launching a decentralized mainnet with economic incentives is very difficult. We've done it for a lot of different other networks. A lot of people need to agree to the right structure at the right time, and it's just been a never-ending story. But we're making a ton of progress, and so we're very close to a few very important milestones to be released. And so I'm going to walk you through those. The Ethereum POS world will be by far the largest POS network. It's going to create the largest financial product around staking that we've seen in the blockchain space to date. Ethereum is really, outside of Bitcoin and Ethereum are really the standard components of any investor's portfolio at this point. And I think those are the two protocols that are genuinely regarded as being somewhat ready for institutional grade investors. And we can argue in between Bitcoin and Ethereum, there's respective communities who might differ on that, but let's leave it at that. In order to run a validator node and earn interest, you need at least 32 ETH on a node. And so that's there's a minimum requirement. You can't just spin up a node, nor should you want to, because there's actually a base cost of running a node in terms of storage and compute. So you can go on Amazon, set up your own little virtual machine and run Ethereum software, and you'll see that you'll end up paying, let's say, $100 a month for the infrastructure component. And so that's $1,200 a year. And so you need to earn interest that actually at least covers that cost, right? And so if you assume a 5 or 6% yield that you often see on these tokens, then on 32 ETH, that's actually not that much. And so depending on where the price of ETH obviously lies, and so that's an important component. There's a very interesting website that we always recommend. It's called ETH Calculator. It's in the stack, and you can check what it costs. Like I think right now the cost is like $12,000 or $13,000 would be the stake on it, and so you can see how tricky that is with a yield of 5, 6, 7, 8% to actually make the math work to have the node pay for itself. Okay, so there's you're definitely betting on appreciation of the token value itself, or you find a way to lower the cost of running these nodes to a pretty extreme degree, or you have so much ETH that the yield by far outpaces the respective cost. But ETH Calculator is a great tool, and you can play around with the math and do a bunch of different things on that respective network. And so it's a very, very useful tool I find. Let me also keep an eye on time. All right, and so we're currently, this has been sort of this year and the future. The phase 0 launch staking only is upon us. And so that's been a huge milestone, which is, I'm assuming, where we're speaking. There's more and more noise. You can see liquidity services coming online. The reason why they do that is because every time you stake tokens on a node, you're connecting these tokens to a node, and there's an unbonding period. These tokens, you can't just then take these tokens off right away. That would create a huge risk for the network. If everyone would do that in the same second, the network might go down. So there's an unbonding period, and which is ultimately a smart contract. And very early on for Ethereum, that will be nearly 12 months for ETH 2.0. So it creates a huge opportunity for liquidity providers to say, you know what, I'm gonna use you put your 32 ETH on your node, and I give you 32 ETH at a particular fee, and it all comes into this overall calculation of giving you access to liquidity, and your collateral is the ETH that you have running on your node. And so that's a very popular product these days that people talk a lot about. And then you'll have another big update, which is really phase 1, where staking and read-write data, when the physical network can actually handle any transactions. Up until then, it's a pure speculative network. And then you have, transfers and such things come in play when you can then physically actually trade the tokens away from a node. The owner here is the Ethereum community. So expect delays and arguments across these different phases and rollouts. And it'll be fascinating to see how that evolves over time. So a very, very exciting project. But, I would say we're still pretty far out from this being able to be used by everyone, right? Couple of things around POS consensus models and why Ethereum chose to also move into it. Ethereum currently is a proof of work network, and the very simple math here, depending on the consensus, is that it's more expensive to break a POS network. Depending on you need a 2/3 of the funds need to be connected in order to jeopardize the network, versus 51% on a POS network. So it increases security to an extent, and that is often used as an example. There's a couple of economic reasons around inflation rates and such things, because you're in theory not minting new tokens. Proof of work, as you know, there's a regular cadence of Bitcoins that get minted every day, and that got halved. Like, we're slowing that number down. But if you follow the crypto markets, yesterday, for example, it was the highest market cap value for Bitcoin, even though the price of Bitcoin wasn't at an all-time high. The reason why that is that there's more Bitcoin available now than there were 3 years ago. And so in a proof of work network, we pay for the security and performance of the network by creating more tokens, which creates inflation. And so that's an economical component. There's the general point that POS requires less energy, which is true. You need a lot less nodes and compute power in order to validate transaction on such a network. Yes, to be debated, but let's leave it as that. And then it provides transaction finality. And really what that means is a transaction, once it's validated, can never be undone. And in a proof of work network, that's to be debated. And so there's a couple of reasons from a security and performance perspective that ETH 2.0 will be powerful, specifically on the scaling part. And so, whoops, sorry. Where were we? Whoop, here, benefit. Okay, so and so there's a couple of quick things. The only risk you have when you stake your tokens on a node is that the validator could do something that gets punished by the network. We've mentioned slashing. If you're unfamiliar with it, it really just means that if the node is in any way responsible for jeopardizing the performance of the network or the integrity of the network, there will be a financial penalty, which means that certain percentage of your 32 minimum ETH that sits on a node will be taken away and either burned or put in some foundation funds given out to other people. And so there's the risk of losing probably not all of your 32 ETH, but there is slashing risk, which means there could be a scenario where suddenly your 32 ETH are 30 ETH, and your node becomes inactive, and you need to add 2 more ETH in order to come back to it. But there's a chance of loss of funds, and so it's very important to run quality nodes. It's not something that you want anyone to do, because you run the risk of losing funds if you're not fully, an expert in this respective system. In general, nodes are at the forefront of anything blockchains do, and so for us, obviously, we're a node operator, and we've made that bet very early that people will outsource management of node and risk, and we've seen that increase drastically over time. 2-3 years ago, every major player really wanted to run their own node for security and performance reasons. The general technology around nodes at this point has evolved to a degree where our performance and security is pretty much higher than any individual institution can provide for themselves. And so there's been an interesting technological inflection point where we've SaaSified and commodified node operations to a degree that the performance just is far better than any individual engineer, no matter how good, can run a node off. If you're one engineer running an Ethereum node for the company you work for, no matter how brilliant you are, if we run 100 nodes for exchanges and custodians and financial institutions, we just have a much larger feedback loop. We have much more use cases and scenarios, and also more engineers over time automating and improving node functionality. And so we're also ISO compliant and certified and externally audited and have insurance. And so, we can enter into legal agreements that protect security and privacy for institutions here. And so, but one of the key things is, one of the big evolutions that we see is that what you'll find is, with more institutions coming into the space, more trades being executed on blockchains, specifically the requirement of these nodes to be scalable up to handle unusual peak times, for example, is very important, which actually requires more complex high availability node setups. And so for a lot of our exchange customers, for example, we now run clusters. And these are geographically dispersed around different cloud providers, different territories. They have a load balancer. And so there's actually systems in place where we can guarantee that the node will pretty much never go offline, no matter what the incident. And so, but that's been important, and that's a big trend, is to make the nodes so high performant and flexible that you could have a scenario where suddenly, you have 1,000 transactions per hour, and suddenly you have, and now we have 10 million transactions an hour. And so if that's an unprecedented amount of load on the node, often these systems traditionally used to break. Coinbase goes down ever so often. And so developing kind of infrastructure that preempts that, it's been one of our core services. As the second point, so you need to exceed any kind of scenario a user could probably want in order to provide perfect uptime. And but the reason why that matters is, a lot of investors, for example, who are trading houses, that's their bread and butter, and they need to make sure their transactions go into the block at a really fast speed. And so you want to, really, and they can't have flashing risks and such things. And so the complexity of the underlying infrastructure for high performance financial services is enormous. And we're that sort of layer that makes that connection possible. And so that's an important trend. Let me see. Oopsie. And so this is how, for example, our high availability deployment looks. There's failovers, load balancers, monitoring, automation, all that type of stuff. I'm not going to bore you with this because it might get a little too technical. But this is our individual monitoring backends, where we monitor actually a bunch of different things. This is monitoring on the tech side. There's also financial reporting tools around the node performance, yields, and stuff like that. So we offer multiple dashboards for people to look at the node. And it's really a choice of the user, what they're exposed to. We don't expose heavy This is how it looks from our side on the back end. Most of our customers don't want to know. What they want to know is their node works perfectly all the time. That's all they want to see. And so we have a little indicator in our dashboard that shows them how well their node is performing, and they normally only care about that number. And here we talk a little bit about load balancers, things like that. I leave it in here in case you're are interested in such things. I'm not sure how technical the audience here is, but it's an interesting setup and shows you how we actually physically operate these networks to ensure that performance and transactions always hit the mark. And same for failover systems, obviously. So what happens if a node is not working? But basically, you always know roll a network forward, which means you never fix a node. Something doesn't work, you kill it and you launch it afresh. And so looks a little different per protocol. We often have fully synced nodes on standby that are fresh and healthy that we can circle into a network within seconds if we need to, for example, which then increases the overall cost of the setup because that node actually needs to function in the network as a full-on validator. So there's a cost in relation to that node. Sorry, always takes a minute to, okay, so here we are. Defined yield farming. I want to talk a little bit about that since it's been mentioned, and it's a subject that was very popular over the summer when sushi occurred. So there's the sushi protocol. If you're interested in yield farming specifically, I urge you to Google it and read about it. The really fun case studies occurred where people made enormous returns for a short period of time based on DeFi. DeFi stands for decentralized finance. And really what that is you kind of put your yield farming can be putting your Bitcoin in a wrapper and putting it in a protocol to provide liquidity in a network, and you earn interest on it. And so there's different ways to do that. And so there's networks who incentivize people to give them liquidity because they use that liquidity to power particular network functions. And often, they run this like, they create a little stock, a little token that they use that you trade into, and then that token participates in the reward mechanisms that the respective network creates within running of its service. And so in a world where gas prices go up and Ethereum occurs, people pay a lot of money to get transactions in, and often these gas fees and get floated, and then you create exuberant returns for some of the investors that live on those yield farms and can make 10x, 20x, 50x, and obviously in the crypto world that always gets people super excited. But there are certain distinctions that are important to understand, and so the important thing here is that there's very different risks. So what's the difference between yield farming and staking? And so there's different staking functions on the protocol level. You actually put native tokens to work to secure the network, and you earn native tokens. And so yield farming is a function at the application level, and there's a smart contract risks that dictates sort of the oracle, which is the exchange rate between the whatever base currency you provide and the liquidity it gets translated into in the other protocol that lies underneath it. And so there's a lot higher risk for exploitation, and we've seen a ton of that. And so smart contracts can be hacked, specifically when people get greedy and launch these things very quickly. Security normally is not taken as people are, security and multiplier. The degree of security, there's an ironic incident. The more valuable the network becomes, often means that the multiplier and return is very high, which actually lowers the security standards people want because they take much higher risk in the network because they want the high returns. And so the higher the multiple, normally the less secure the network. And so, so the risk is very, very speculative. In no way should you put any funds in that you ever, think you might need, nor is it really a world where institutions can play just because it's so unpredictable. it's also kind of really goes through a very particular life cycle, like farming. There's certain seasons for it, but you really need to be in the game, and you need to play daily into it. And so there's also they differ fundamentally. I've mentioned some of this. There's some more information here in the deck. Yield farming uses liquidity providers that add funds to liquidity pools, and then those are smart contracts. And then they get investors provide these funds and get a reward from transaction fees generated. So I talked a little bit about that. One of the big things here is the reason why that also became such a trend is that you've seen a lot of people highly incentivized to connect protocols to each other. We do that as Blockdemon, offering bridges as a service and wrapping tokens and connecting them to other protocols. It's good business because you get to generate transaction fees. For us, that's interesting because we have total addressable market dollars per nodes per month, but there's a sort of limit to the upside. But on transaction fee volume, for example, the total addressable market story sounds a lot more interesting. But those whole cross-chain bridges and stuff give a lot of opportunity for liquidity pools and DeFi products. So you'll hear more about yield farming, and there's going to be a lot more opportunities to participate. Just know that the risk is much higher, and it's much harder to predict, for example, investment returns. Not that we ever do that. We're not an investment company, but on a staking protocol, the yields are pretty clearly defined, and the interest rates that you earn, you speculate on you have enough speculatory risk on the actual value of the token. And so here you're doubling up on that risk because there's a token on top of a token. Look at the time. All right. ETH 2.0, early staking. So we bought a bunch of slots. We put 32 ETH on a bunch of different validators. You can currently reserve slots. The network's starting up. We always like to be early. We believe opportunity happens early in these markets. But what that means is it's actually illiquid, and we probably can't touch that money for over a year. And so it's important to know that there's been products now that actually, as I mentioned, provide liquidity on top of it. And so they are kind of like yield farming, stakey type of solutions, even though they have mitigated a lot of the risk away. And so you can connect Ethereum to your node and generate liquidity as well, and people will manage the risk for you. There's a price for it, but it makes a huge impact. And because ETH 2.0, the yield and rewards initially won't be tradable. And so for a year, when you plan your own little, how you handle your own Ethereum holdings, when you sell, how you manage that whole liquidity and predict market movements is complex enough. But then you also have to factor in, if suddenly, for example, I'm giving a random example, again, no investment advice whatsoever, but if a ton of people would throw their Ethereum on ETH 2.0 nodes and make it illiquid for 12 months, you'd have a lot less liquidity in the Ethereum market and prices would go up, which then would mean that a lot of people who have their ETH sit on nodes would get very antsy and probably willing to find ways to liquidate some of their assets and have other people take that risk. But then it also creates the scenario where suddenly trading becomes possible after 12 months, and then you have a token fall off a cliff. So there's a lot of different economical models and considerations here. No one predicts anything right in the space. There's too many factors to do that, but that's one of them. And so there's a little more information here on liquidity, but those are the core principles of it. I'm going to come to an end here just because I want to be open and have time for questions, and it can be a little bit dry. We at Blockdemon, we run a bunch of different Ethereum solutions as part of our general service. You can go to our marketplace. We run white label Ethereum 2.0 nodes. You can launch them if you have 32 ETH. We charge a fee per month, and that's easy to do. We also run full Ethereum nodes, permissioned parity networks, archives, APIs, all that type of stuff. Anyway, which you would want to connect to Ethereum, we have a solution for it. We are working with a couple of liquidity providers currently to also make sure that we can offer people who purchase nodes and stake their Ethereum with us optionality around liquidity. And so we're thinking about that very actively as well. And so that's our current stance. We are launching a few additional new features. One thing to know about Ethereum 2.0 as well is that there's quite a few different clients across the spectrum there. Clients are really, again, the little software component that sits on top of the storage. And we ran and tested all of them and selected two that we work with at this point to ensure uptime and service performance. But yeah, so we're at 10. Yeah, this is a good time to maybe pause and say thank you for everyone who listened. I want to see if there's any questions we have. I don't see any. And so I'll leave this open here. I'll be here for another.
Can you talk about delegation as well?
Sure. Yeah, I mean, delegation in principle ultimately means, you don't need to run a node. You can also, I mean, there's different ways of, there's delegated proof of stake and directly delegating to a node. And so really ultimately what it means is you can power your own node or you can delegate to somebody who manages and runs a node. The main difference is that when you take delegation, when you just delegate to someone, you pay a fee. The fee tends to be between 1 to 10% of the earnings of the node. And so ultimately, the big calculation people always make is what's the cost of operating a node? And is it worth my while to just delegate to someone and pay the fee of the earnings? Or do I run my own node and don't do that? And so depending on what the market prices are, it really varies in a new network. It takes a long time for the fees to even itself out. They tend to land between around 10%, and then they filter down based on size of funds. But that's an important factor when you think about what to do with your ETH, right? And so if you sit on millions of ETH, then delegation might sound less attractive because sharing 10% of the earning of that yield might still be quite a lot of money, which is why our business is very focused on institutions, and we run a lot of nodes for people who own $20 to $50 million worth of tokens. Because for them, if there's a 10%, let's say there's $5 million in rewards per year, 10% of that is $500,000 a year. That's a significant amount of money when you can pay for a node to be operated for a couple of $100 a month, for example.
Nico has a question here. What do you think the likelihood is of phase 0 ETH staking starting on December 1st?
I don't know. I mean, based on past indicators, less than likely.
Yeah. Can you talk about, you mentioned institutions, and you on one of the slides you had Shell and a few other enterprises in there. Can you explain a little bit about what you're seeing with institutions and enterprises in terms of why are they looking at staking? How are they doing it? Even to the point where, where is the, how is the funds transacted? Is it coming from their treasury department? How are enterprises making use of staking?
Yeah, it's a good question. And to clarify, so with Shell, we run permissioned Ethereum networks for them, which is a little different. On the staking side, I'd say is mostly financially incentivized institutions. And so banks and funds, which we classify as enterprises, right? So there could be huge entities like Goldman Sachs, that to us is an enterprise customer. And the way I think most of them are looking at it as something to experiment with, because they are able, when you have a banking license, you're now allowed to hold custody. You've seen announcements, and we've seen a lot more and we're working with quite a few folks like PayPal, Stripe, or Square, or anyone who's going to offer payments and acceptance of payments means they can custody tokens, and they think as part of their financial services offering over time, if people, for example, deposit a ton of ETH into their accounts, that they can monetize that ETH over time, for example, by looking into staking solutions. Much more common with large exchanges, the Binances, the Coinbases, and all the larger custodians at this point, just to be clear. I think the actual adoption on a physical enterprise grade is relatively low in terms of physically moving funds aggressively onto staking. But on the crypto native side, you see a ton of it. And mostly it's because they sit on a lot of assets, and a lot of people don't even consciously, they don't want to stake. So, there's always a huge amount of tokens that never get staked, even if yields are very high, because they sit on some exchange in some wallet that somebody hasn't looked at. And so it's very, very interesting for those type of entities to figure out the legalities of how they can actually use the funds they hold in custody to earn yield on, even if you haven't given them permission to do so. And so that's a big market offering, and something a lot of people think about. Obviously, large holders of these tokens are investment funds, and they are all very aggressively looking what to do with their tokens that sit on a balance sheet for them.
What geographic regions do you operate in, and how much does geography factor in proof of stake and staking?
So we operate worldwide. We have pre-configured data centers, dozens and dozens of them on all major continents, and so we also have flexibility there. The main driver is regulatory compliance by people who want the nodes. So where you run the node and earn yield is where you have to pay taxes on them. And so the investor needs to have an entity in a respective market. So for example, they say, hey, we need to run this node in this particular territory because that's where I need to have the legal responsibility to pay taxes for it. And so that's really the main driver for a lot on the investment side. On the network performance side, we disagree with that approach because we want latency and disbursement. And so, which is why we have a very large customer segment that are foundations, and which are the actual protocols and foundations themselves who pay us to run nodes in regions, for example, that not a lot of investors would like to run nodes in because for latency, because they don't sit there, they don't reside there, but it's good for the network to have wide dispersion and of nodes.
Great. Any other questions? All right, Konstantin, I guess we're all set. So thank you very much for taking the time to speak with us. Really
Always.
Appreciate it. How do people get in touch with you? Is there Twitter accounts? How do they follow you?
Twitter, Konstantin11, Konstantin with a K, Blockdemon, blockdemon.com, hello@blockdemon.com. Very easy. Also, FYI, if anyone works at a company or knows Ethereum developers, we're aggressively hiring developers in the space as well. And so we're seeing a ton of growth and opportunity, specifically in ETH 2.0. And so our team is growing very quickly. And and if we can be helpful, please feel free to reach out. Always happy to talk and learn in our respective ecosystem.
Great, thank you. Teresa, do you want to close this out?
Yeah, this is Brittany. Thank you again, Konstantin. If you want to, you can place your social media handles in the chat so it's easier for the attendees to follow your work.
Sure.
Yeah, thank you. For everyone else, if you're interested in all the leading blockchain work going on in the EEA, please feel free to reach out to our membership director, Jack Leahy, or you can send an email to membership@eea-alliance.org. Again, that's membership@eea-alliance.org. So this will conclude our session for today in the EEA Education Series webinar. Have a good day, everyone.
Thank you. Bye.